I'm Tony Brierley. I'm a partner in PM+M and I run the financial planning operation. Well, in terms of long-term care, there's been a lot of talk and a lot of stuff in the press about the cost of care and the fact that we're all living longer. Our message essentially is one of reassurance. For people who are on their own or are widowed, provided they've got some reasonable retirement provision, they could always sell the house and, in all probability, have enough funds to meet the care bills without making any diminution to the capital that they hold. And the rest can be passed on to the kids, and that's fine. The interesting situation comes where one person's in care and the other person is still living at home. In this situation, some careful planning can lead to some very significant savings. So the key to it really is work out the numbers for yourself in advance, and that'll be fine. But when planning for the costs of long-term care, you need to work out what your assets are and the income they can generate. You need to have one eye on liabilities, but more importantly, think about the income that you're getting from your retirement provision and what the assets generate. Then you need to work out roughly how much the care is going to cost. Having done that, you need to think about who holds what assets. You might take advantage of the new pensions rules, or alternatively, for instance, you could invest in investment bonds, which are not accessible for long-term care. The key thing to remember is there's no one-size-fits-all. Every case is different, and you will have to work out the particular circumstances for yourself. Well, in terms of inheritance tax, the first thing you need to do is to make sure you're making the most of all the exemptions available to you. So, most people know they can give capital away every year of £3,000, or they can give gifts in respect of a marriage or small gifts. What many people don't realise is that they can give any amount they like to whomsoever they want, provided they can prove it's out of surplus income. And the important thing to remember here is to make sure you keep a record of it. Then, of course, you can do potentially exempt transfers, PETs as they're known. Now, they take 7 years to clear your estate. And another aspect that's becoming much more popular and prevalent these days is business property relief. This came from when private companies, the shares in those were not assessed for your estate, provided you'd held them for 2 years. The final thing that I'd suggest at this point is look at the new pensions rules, because there are some tremendous planning opportunities for everybody there.